And welcome back once again to all of our options traders. Well, I hear a lot of times traders saying that they only trade high volatility stocks because they have a better chance of making a bigger move. And yes, that's true, but remember, price is the equalizer. Other traders recognize that, and those prices get bid up accordingly. It's all baked in. So, should you just go out and search for high volatility stocks? Or should you search for stocks that you want to trade and maybe make them behave as if they're more volatile? Well, that sounds like kind of a strange thing to do. Well, let's go find out. How can you add volatility to your stocks? And before we do, as always, please be sure to click like and subscribe. It is greatly appreciated and helps to promote the channel. So first, let's take a quick review of volatility. It's really just this idea that there's an erratic nature to stock prices. All of the zigs and zags that we see on a day-to-day basis. So yes, it is true that high volatility stocks can make bigger moves, but remember that's up or down. And again, traders often look for high volatility stocks for this reason. They'll say, well, if I buy these high volatility stocks, I might make a big move, but I've got this limited downside if I'm wrong. But again, that's true, but you've got to pay for that benefit. You're going to pay more for those options. So the question that we want to find out here is, how can you make a low volatility stock behave like a high volatility stock? And with options, we can do it. So first, let's also take a look at volatility graphically. If we have, let's say, 10% volatility, you'll notice that here we've got a $100 stock. There's lots and lots of trials of $100 stocks at 10% vol over a 250-day period, which is roughly a trading year. And you can see it's quite focused, almost like a beam of light. But if we go to 20% volatility, we start to spread out here. On the far right side of the chart, you can see it's a tighter grouping here at 10% volatility, but they tend to start spreading out more at 20% volatility. And then if we do 40% volatility, now we really start to get wacky. All three of these start at 100, but we've just changed the volatility. So again, this is a good visual why a lot of times traders like to look for high volatility stocks. There's only so far they can fall, and if we're trading an option, we've got this nice limited downside, but look at the potential for the upside. See, if you're trading a low volatility stock, you're looking at this going, it's not really going to move all that much, most likely. Whereas if we're trading the high vols, we have the potential for more profits. Well, again, this is overlooking the mechanics and the benefits of options. So we have to understand the connection between time and volatility. Remember that time and volatility are two ways to give your option a better chance of moving in the money. Yes, you can trade a high volatility stock, but with low time on your option, but you could also trade a low volatility stock with high time or a great amount of time until expiration. But to do that, we've talked about this many times before, but remember our friend, the square root of time, the square root pricing principle. So if we have a 30-day option at 40% volatility, and we also have a 30-day option at 20% volatility, how can we make these equal? Well, remember, I can't just double the volatility and say, well, 2 times 20% is 40%, because there's this square root connection. We have to realize it's the square root of 4 that gives us 2 times the volatility. So if we take the 30-day option and multiply it by 4, that means that a 120-day option at 20% volatility will behave like a 30-day option at 40% volatility, at least in most categories. And again, this is where you have to understand your options. But let's take a look at the one that traders are most concerned with, which is delta. So here is a delta curve, and we are comparing a 30 days to expiration option at 20% volatility to a 30-day option at 40% volatility. So we've got the $100 call right here. We're assuming that the stock at this point is also 100. And you can see if we trace a line up, both of these, the red and blue curves, show a delta of about 50. And I think most of the traders know that. And at the money option, we'll have a delta pretty close to 50. But notice if the stock falls, maybe we fall down here to 85. Now your 30-day 20% volatility option is going to lose most of the deltas. They're pretty close to zero. Whereas the 40% volatility is still going to hold some deltas. Just because it's an out-of-the-money option now, there's still a decent chance for it to become in the money. So it's going to hold more extrinsic or more time value. But if we move up here to in the monies, we're going to get the opposite effect. So let's say that the stock is up here at 115. Your 20% vol option will have deltas pretty close to 1, whereas your 40% vol option might only have deltas at 85. So this is what's called the Trumpification effect. The in-the-money options are pushed lower at higher vols, and the out-of-the-money options are pushed higher for those deltas. So whether that's a good thing or a bad thing depends on your needs. But watch what happens if we make the 30-day option, if we instead purchased 120 days. We bought a 4-month option, still at 20%. What happens to this blue curve? Well, it's going to look exactly like the 30-day option at 40% volatility. So by buying 4 times the amount of time, I can make the low volatility option have the same delta characteristics as a higher volatility stock. What about gamma? Now our curves are showing gamma, so if the stock is 100, my 30-day option at 20% vol has a gamma about 0.07. That just means we're going to add 7 deltas if the stock rises $1 or lose 7 deltas if it falls $1. But look at the higher vol stock. We have a gamma here maybe around 3.5. So it's exactly cut in half. And we've talked about that before. If you double the volatility, all else equal, you're going to cut those gammas in half. So what would happen if we made this a 120-day option? We gave it 4 times the amount of time until expiration. Well, like I just said, it's going to look exactly the same. Those gammas are going to get cut in half, at least for the at-the-monies. So I can make my gammas behave exactly like a higher volatility stock just by buying 4 times the amount of time. What about the probability for these options to move in the money? So for example, if the stock is at 105, well, remember we've got the 100 strike, and so if the stock rises to 105 and we have the 30-day call with 20% volatility, we come right up here to the blue curve, and it looks like we have maybe an 82% chance of expiring in the money. But if we have the 40% stock, we come over here to 105 and look at that. Not even maybe 65. So they get chopped by quite a bit. And again, that's because it's a higher volatility stock. Yes, there's 30 days to expiration, which might not sound like a lot, but there's 40% vol. So those probabilities get pushed down a lot. And that's why the red curve sits below the blue for all of the in-the-money positions. Again, that's where the stock is above 100, but the red curve sits above the blue for out-of-the-money positions. So if the stock is down here at 90, yeah, your 20% stock has not much of a chance of going in the money. But if you've got the 40% volatility stock, still not a great chance, but getting pretty close to 20%. So again, whether these are good or bad depends on your uses and your needs. But if I make this a 120-day option, what's going to happen to this blue curve? It is also going to look exactly like the higher volatility stock. I can make those behave the same. Now again, you might think, hey, this is great. Let's just trade the low volatility stocks, make them 4 times as long till expiration, and all is good. But again, that is missing the point that price is the equalizer. You're going to have to pay for it. So for example, back over into the OIC's calculator, if we have the stock at 100, the 100 strike, 30 days to expiration and 20% volatility, that option is going to cost you $229. But at 40% volatility, it's going to cost you $457. You're going to pay twice as much for it. Well, what if we go back to 20% volatility, but give it 4 times the amount of time? Let's give it 120 days to expiration, and look at that. It's also going to cost you 457. So you're not really getting anything for free. The question is, can we at least get the same characteristics out of a low volatility stock that we do out of a high volatility stock? And the answer is, for the most part, yes. Just give yourself 4 times the amount of time. We have less volatility, but we have more time. And so they tend to equal out. Now, where don't they equal? Well, that's going to be in the theta curves. So now we've got the 30-day option at 20% vol here in blue, another 30-day option at 40% vol. So because you've paid more, remember twice as much, for the 40% volatility call or put, it's going to have twice the time decay. Or conversely, if we buy the 20% volatility stock, our theta is cut in half. And you can see that we're at about 7.5 cents a day here for at the money and down to 3.5 right there for the 20% vol. But what's going to happen if we go to 120 days with 20% volatility? Well, now because we're going out further in time, we're going to cut that in half again. So now our time decay, or the theta, is only 1/4 the amount of the higher volatility stock. So we've paid the same amount, we have the same characteristics across the board, but we also have 1/4 the time decay. But there's a trade-off, and that is going to be in Vega. So remember, the options Vega is the sensitivity to volatility. So if we have the 30-day 20% vol option here in blue, these are the Vega values, compared to a 30-day option at 40% vol in red, what that's telling us is that if the stock is right here at 100, remember we're talking about the 100 strike, look at that, they both have the same Vegas. And what this means, let's call it maybe 12. It means that if volatility rises 1 tick, let's say to 21% for this option or to 41% for this option, both of them are going to pick up about 12 cents. But remember, because you're going to pay twice as much for the 40% vol, in relative terms, it's only half the amount. However, if the stock price rises, you can see that the higher vol option will retain higher Vega. You can see it dropping off quickly here for the 20% volatility. Same to the downside. The higher volatility stock will retain more Vega. And that's because it has a higher volatility. But if you go out to a longer dated option, you're going to magnify that even more. So if we make this instead the 120-day option, still a 20% volatility stock, what happens to this blue curve? Now it's not going to match the red, it's going to do this. And the Vega is going to be greatly magnified. So you have to say, is this a benefit? It depends. If you're buying this option, or considering buying a longer dated option, and the implied volatility is abnormally high, that's probably going to be a dangerous thing, because you should expect volatility to revert to the mean. And as volatility starts to fall, this option could potentially lose a lot of value just because of its sensitivity to Vega. However, if you're buying the option when let's say the historic or the implied volatility is at a relative low and you're expecting it to move higher, then that's going to be another big benefit just by having the longer dated option. Because even if the stock doesn't move, that option will start to gain value. So it's really in the theta and the Vega characteristics where the decision comes down to whether we should buy a longer dated option or not. But if you're really just trying to trade delta, and I think that's fair, that's what most traders, at least people who are starting with option, are trading. Do I think the stock is going up or do I think it's going down? And if that's true, don't necessarily trade high volatility stocks that you're uncomfortable with just because you think that they have a greater chance for success. You're going to pay for that. We can trade lower volatility stocks that we're more comfortable with, give ourselves 4 times the amount of time, and most of these characteristics are going to exactly balance out. And that is how, in kind of a roundabout way, you can make a low volatility stock behave like a high volatility stock. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.